I want to quickly review what we're doing today, and then we'll do it. We want to talk about a possible road trip to Chicago. We want to review where we ended up last time, old crop decisions, and what were those alternatives that we looked at telling us. Then we'll continue on and do some old crop pricing alternatives using the same worksheets as last time. This puts us on exactly the other side of the chart, so it's a really good teaching opportunity. Then we're going to look at the differences. They're basically the same, but there are some key differences between looking at old crop alternatives and new crop alternatives. That's where we'll go. And then next session, what I want to do is I'll send out this information. We'll kind of know all the marketing alternatives, and we'll kind of look at what market setting we're in now, just a little bit of outlook and technical where we're at, how that matches in here, how might you use your cost of production, your financial position, and try and look at a mini marketing plan, at least how these different marketing tools fit into it. So with that, I'm going to go here, and we're going to have Dennis Stein, an extension educator from the Thumb, talk a little bit about the road trip. Dennis?
Thank you, Jim. It's my pleasure to be on tonight. We've got the opportunity to try and put together a trip that could be possibly participants from this group as well as outsiders. Historically, we've made quite a few trips to Chicago over time, and it's one of the things that really ties this whole package together is to get a good idea of what the Chicago Mercantile Exchange / Chicago Board of Trades, or now it's referred to as the CME Group, how it works and functions. What we're thinking about doing is taking a Tuesday, Wednesday type of activity, leaving early on a Tuesday morning, heading down to Chicago, spend a little time at the board, get an observation at least, possibly work with one of the traders for a little mini session on how things operate, see a few things there in Chicago, and possibly make a stop or two on the way back on Wednesday at some merchandisers or some various facilities. What we're really interested tonight is just to kind of get if you want to call it a tidbit idea. If some of the folks are actually interested in this type of an event, they can either put into the chat box and let us know their intent, and I think Jim's going to probably attach this little flyer to his notes, and if some folks are interested, they can respond back and give us at least their contact information if they're possibly interested. It's not a firm commitment at that point in time, it's just an interest survey, and we'll try to put something together. We're shooting right now for possibly Tuesday, August 12th and 13th. The exact itinerary as far as the travel is concerned, we'll probably start on the east side of the state, come across the state, and slip down into Chicago for the activity. Ned Berkey and I, as possibly even Jim, will be part of the process, and we're excited about the opportunity to maybe put this together. Thanks, Jim.
Thank you, Dennis. The other key note about August 12 is that's where the key August crop report is to be released. It comes out at noon on that day. So I expect any time around then to the close will be a pretty exciting trading period if you're able to get in at that point in time. So that's a little bit another reason for the date, as well as maybe we'll have a few less people in the field then. Last time, these are the charts that we were talking about. And one thing we left off the charts the other times was something called cash price. What's the expected cash price? You know, we looked what a hedge is, what the options would be, what a forward contract would be, what a basis contract would be. Well, all that also needs to be perspective of what do you think the price is. Otherwise, the weight to price line is these three lines in a way. How high do you think, low you think it might be? Some of you have heard me speak or looked at my web page. I usually look at it this way. We're not going to spend a lot of time, but I want you to be thinking in all the alternatives we go through. This is what the market's saying the odds are of it going up or down. And by the way, I assume that everyone got rid of the rest of their old crop soybeans and corn today about 8 a.m., I think, or somewhere right in there when we hit that high. Good at hindsight, aren't I? The markets, the closes look pretty good as well, but not as near as nice as they did when I first turned on the computer this morning. So when we look at these pricing alternatives, we want to be looking at it within the scheme of things, how high the market might be and high-low. Now, these are July corn futures. Cash prices this summer are probably going to be, depending on where, 10 to 30 cents under this. But basically, all you have to do is adjust your basis to these. Now, there is some basis risk too, which would change it a little bit, 5 to 10 cents each way. But that's, in the scheme of thing, that's the lesser part of the risk. So as we look at this, and I apologize for this being a little bit small, but I'll kind of work on that. There we are. There we are. If we look at these different alternatives, anytime we look at a hedge, and remember a hedge right here is 433, whether you can see it or not, but the point is it's higher than the cash price of 426. When that's the case, okay, what it's telling you, let's see if we can get that one more here. What it's telling you is that we're on this side of the, whether the prices are going up or whether the prices are going down, we're on the right-hand side of this. So we're going to be using the tools in the old crop corn example that we were talking about for on-farm. If you think it's going to go up, we're going to look towards stored cash. Or if we want to gain that basis tightening and put a floor under us, we're going to store the cash and buy a put. If we're more worried about going down, we're going to go a little heavier into what we have left into a hedge or hedge to arrive. If we want to keep some upside potential, we'll store that cash and buy a put. Now, last week's example on old crop corn, we did on-farm storage. That put us on the left-hand side here. If we'd done an example with off-farm storage, we would have ended up on this side. But we're going to look at this side right now because we're going to do examples in old crop soybeans. Or when I say old crop, remember that's stuff we have in the bin right now or stuff we grew and we harvested in 2013. When I get to new crop, what I'll be talking about is crops we'll harvest in 2014. As soon as we harvest that, then of course old crop, that becomes old crop and we flip to 2015 for new crop. So we're going to go through now a soybean example. We're going to look at the alternatives today as if we still had the soybeans. And I'm sure a few people out there still have soybeans, physical soybeans, okay? I suspect a lot more, at least if they listen and want to stay in the market, they're in a basis contract. And by the way, most of this upside gain, we would have been able to get that from the basis contract without having to pay storage since harvest time. So if we look at this here, what we want to look at is what are the prices that we're looking at. So I want to talk about these a little bit. And you have them over there. These are the prices we're going to deal with. We're going to, this would be Friday's close because I prepared this over the weekend. Soybean prices were down 5 to 7 cents today, so the story really hasn't changed. What information we need? We need the July soybean futures. That's 13.85 and a quarter. We'll use 13.85. Cash price at the close was 409. June forward contract, otherwise the forward contract based on July futures was 390. Now, what would that mean? Of course, that means they were offering a positive 5 cents at this particular location. This is over, let's pretend it's Zealand Co-op. And then we look at our options down here. Soybean options trade in 20-cent increments versus the 10 cents in corn. Percentage-wise, it's no bigger spread because remember, corn is only a third this size and it's a 10-cent one. So percentage-wise, this spread between options is no different. So if we look at this 1280, if I wanted a 1280 call, I want to buy the right to buy. Okay, it would cost me $1.2225. Remember, because that's 2/8. Why is that? It's because futures already are $1.05 higher than that. So $1.05 of that would be your intrinsic value, and the remainder, the 7/8 cents, would be time value. And down there, there's not a lot. If we go to the top side here, 1480, okay, it cost you 24.08 cents, so basically, great, 24 cents. But we're going to be probably looking at, so when you go back to refer to this, and this is one of the pages that I sent out, so that when we're going through the worksheet, you'll have it right in front of you. We'll be looking at 1380 and 1360 and 1380 puts. That's the right to sell, so it's the right to hedge. So we'll be looking at those, and we'll call them 43 cents and 53 cents. We'll round a little bit. Although if you got that spreadsheet, you could put in the exact numbers and it would be fine. I forgot to tell you on that spreadsheet, I'll show you a little later what are the input ones, but it's not here right now. And for the call, we're going to use 49.25 cents, or we're going to round it to something's not right here. I think my cheat sheet here is incorrect. We'll work on that. I'm a little scared here. I think my anyhow, we'll this is in. Now I need to go check on the futures markets. But anyhow, the $14 call is 49 cents, so our cheat sheet's wrong, but we'll fix that as we go through. Sorry, I'm got a little flustered here when I must have got something typed in a little bit wrong here. So as we go through that, we'll work on that, and we'll see what it means. Now the next part of that is going through the worksheet, and I'm pretty sure this one here is right. So your cheat sheet might be a little bit wrong, but we'll fix it as we work through this worksheet right here. So we're going to be using the numbers off the sheet you have right there. The first thing we do is the date. The date is 2/28/14. The current price, if we look on that sheet, cash price is 14.09. We can do a forward contract for June delivery for $13.90. less storage. And I put in 20 cents. That's pretty low opportunity cost. That's more like a 5% loan that you have to pay off, or actually a little less than a 5% loan to pay off. 20 cents from $13.90. By the time we got there storing it, you're at $13.70. So we're already learning one thing. We're learning that the current cash price today is better than a forward contract being offered today. Net government loan rate is kind of not that important right now, given the new government programs, which there was an announcement today, you may be signing up after you harvested the crops. We look at a basis relative to the July contract. Notice that's 24 cents. How did we get there? If we look at the July contract here for $13.85, the difference between $13.85 and 14 is a positive 24 cents. So if I was doing a basis contract, it would be a positive 24 cents. That's where I deliver the beans today, where they can turn around and sell them for the $14.09. I mean, they would have their premium they're selling it for. And then they would buy futures for you, or they would just call it a basis contract. Or you could sell the cash and buy futures and just ride on that. This particular year, historical basis over there is probably about minus 15 or 20 cents. But I'm predicting this year the expected basis will be about 0 or maybe a little less. Notice right now that they're offering a positive 5-cent basis right now. So when they offer a basis right now that is higher than, say, your historical average, you pay attention to that, because you want to get something close to as good. If that doesn't work, then you wouldn't want to do it. We take off storage cost. And remember, the basis is not, you've seen me subtract it a lot, but the base is an adjustment. If it's positive, you add it, and if it's negative, you subtract it. You adjust for the brokerage, and we have a net price of $13.60.64. And that should follow along. I'm over here until we go a little bit later with this chart right here. Then we go to the July options, and let's look at two of them. We're going to look at $13.60, and we're going to look at $13.80. Okay. But I want to stop right there for a second. I want to go back. Here's a hedge of $13.64. Today's price is worse than that hedge. Okay? What that's telling me right now, so be thinking about it, is we're going to be on this side of the chart over here. Okay? So just because the hedge is lower than the current price doesn't mean, I better sell today. Now, for other reasons you may want to sell today, it's just that we won't use the hedge as one of the tools, and probably won't use the forward contract as one of the tools. But we still have the options here left. But one thing we wouldn't use is this one down here, storing for cash. So we look over here, we're going to leave the expected basis at 0. So that's no adjustment. Otherwise, I'm expecting the cash price to be about the same as futures. We still subtract off storage cost. We subtract off brokerage cost. And the option premium, if we look back over here, is 43 cents for the 360. is 53 cents for the 380. Now, why is it that it costs more? It's basically, I'm paying 10 more cents for 20 cents more insurance. So if you do need it, that's not a bad idea. On the other hand, if you don't need the insurance, you'd rather pay 43 cents a bushel than 53 cents a bushel. So when we do the math on that, the spreadsheet did it right. We have 1306 expected minimum price, and we had 1296. Okay. You would expect it to be a good deal lower than this. This is the one that compares the closest, 1380 and 1385, and it's going to be lower by the 53 cents and this 5 cents here. The extra premium, and we're picking one just a little bit lower than the futures price. Now we're going to redo our math a little bit here in this other one, but we'll get there. iPhones have a really nice big calculator on them, so it won't, even ones where I can see and my fat fingers won't mess it up. So we'll come over here with July, okay, and we're going to do a strike price of $14 in both of these cases, and it's for an example. The cash sale is, I'm going to go ahead and sell it for $14.09. The other one is I could forward contract it for $13.90. These are the sheets I suggested you copy off. There is no storage cost here because we sold it. It's gone. Here we have minus 20 cents. We have our brokerage cost of -1. As I suggested, that might be a little low for options. And there on your cheat sheet you have a mistake, but we can fix that. We come over here, and for 14, we have 49 cents. I obviously forgot to change it from a previous, so what do? I write 64. Minus 49 cents, minus 49 cents. These two are the same for this options up here. So this is a pretty good one here. How do we do this? This one any of us can do. We're going to take the 1409, right? And basically we're going to do what? We're going to subtract 50 cents from that. So we minus 50 cents, and is equals 13.59. Okay, now that's not as good as the cash price. It's almost as good as the hedge price, but remember the hedge has no upside potential, and the call here does. Remember, a big part of this here is being paid for, one by the higher price than the hedge right now, but the other to the lack of storage. Over here, if we take 1390, minus 21 for these two, minus 49 equals 1320. Okay. So if I did my math right, that was not as good. Okay, it's 39 cents less. That part your sheet did get right. So now we have our choices here. What do we do? And we're going to talk a lot more about that next week. But these price it today and buy a call is better than the puts, significantly better, as you can see. Granted, we're not comparing exactly the strike price, but this one just under and this one just over comes pretty close. We could make this 1380. The price would have been 9 cents more, So even if this one up here was the 1380, this number here would have still been 1350. So 1350 is still better than these. So we look at those, and we're on, as I suggested, we're on this side of the chart. The next decision is, you know, do you think it's going up or down? And then we're going to talk about a lot more. What do you think the odds of it are going up and down? How does this compare to your cost? Given the odds, how does it affect your financial position if the price drops? How does it affect your financial position as it goes up? And can you afford those changes in position? Okay, so then what happens? Okay, we're going to do an up example and we're going to do a down example. The first example we're going to do is price is up. Okay, so let's say cash price goes up to $15. Okay, I don't, you know, that's 91 cents. In this day and age, is 91 cents that big? And I would argue it is. We're in June now. Okay, so we're getting within 2 or 3 days of needing to get out of the options. If we stored it for the 20 cents, we'd be at $14.80. Okay, let's say futures, July futures were $15.10. Okay, so the basis did turn out to be back 10 cents under a more historical norm. They could have been 10 cents over 2. Okay, net price from the basis contract, remember it's positive 24, so $15.10 plus 24, okay, equals $15.34. Okay, so just as this chart indicated, okay, store cash versus the basis contract, we knew from the fact that sell today was better than a hedge, we were on this side. The market moved, sure enough, we're on this side. And you're going to find even when prices go down, the same thing happens. So let's go on down. So the cash price here was $15 in June. Because remember, in a hedge, you're still getting the cash price. To get this one up here, you have a positive, one side of it is your cash price and the other side is futures. So we sell and buy futures, and we lost $1.25 there. Okay, how'd we do that? $15.10. So we sold it for $13.85. We bought it for $15.10. That's a loss of $1.25 in the futures. We had to pay our brokerage. Storage and brokerage. So that cost us $1.46. You take $1.46 off 15, and you come in at $13.54. And up to that point, the spreadsheet chart over there is correct. $13.54 versus $13.64. The basis turned out to be 10 cents weaker than I expected it to. Okay. If I'd done more of a historical norm, we might have nailed it on the nose. Now let's look at options. How did that work out when the prices go up? And of course, when prices go up, we're going to win in only one options market and lose in the other, and vice versa when the market goes down. So first, let's look at these, and we're looking at 1360. Now, you have a right to sell at $13.60 and buy it back for $15.10. Is there any intrinsic value? Does anyone want to instead of offsetting it, which is just selling it, which I'll tell you right now we'll get nothing for offsetting it, otherwise the intrinsic value is 0. You certainly don't want to exercise it, which would mean actually take a sell at $13.60 and have to buy it back for that, because that'd be $1.50 loss, and we don't want to do that. So we let it expire or we sell it. What happens? Turns out there's a penny time value I'm claiming. So actually I went to sell it and I was able to get a penny a bushel. That's positive. Penny time value, no intrinsic value. We have a time value of a penny, which means we could sell it for a penny. So we pay our brokerage fee. Again, the brokerage fee might be a couple cents. We still sell the beans for $15. Okay, so if we sell it for a penny and we paid and the math on that thing dry, we'll do it right here. So we sold it for a I should have had a positive. You'll be able to go fix it. The spreadsheet's not the problem here. The problem is the operator. You would never have a negative premium. That was supposed to be a positive penny there. So if we paid 43, we sold it for a penny, we lost 42 cents. Over here we lost 52 cents. Storage cost, we still owe. Brokerage cost, we still owe. So the net return here is minus 63. Remember that I double counted that penny. This would be minus 73. You take that off of this here, and you have 1437, and over here you have 1425. Okay, so is this price higher than this? The answer is yes, because basically what happened is you stored the cash, you got a higher price for it, and even after storage and paying your brokerage, you came out a little bit higher. Okay. For those of you who have 3 computers sitting around, so you have your spreadsheet set up on your extra computer, if we look over here a little bit, this is a PDF here, but the yellow is for input. Okay, so when I put in the current price of $14.09, it's also in bold. Right above that arrow there. That's both an input, and if you sold it today, it's a final price. The final price are in bold. So you put in July, that's an input, therefore it's in yellow. 1385 is an input in yellow. Then you see the rest of the dates are in red. Once you put in July, the rest of them are July. Because that's the one we're working on this spreadsheet. You had to put in the forward contract price. That's an input. Right below it, you had to put in the storage cost. Once you put in the storage cost, you notice the rest of the storage cost just say minus 20. You don't have to write them in each time. You do have to put in the brokerage fee. You do that once. You do have to put in the options across here. Minus 43 and minus 53 were correct. Obviously, my minus 64, I apologize for that. It was a prior example when I was building the spreadsheet, and that should be 49 cents. So the calculation would be right. if we did it right. Down at the bottom, there's very little input, as you can see. Yeah, you have to put in the $15 cash price, you have to put in the future, the basis is, and then you have to put in the premiums here. What I'll do is I'll fix this spreadsheet here, so if you start to put in a minus like Hilker did, Professor Hilker in front of 100 people or whatever, it won't allow a negative. So I'll fix that up and put that new one out there. Of course, if you put in what you actually saw on a chart, so this thing's over, that would have been correct. It calculates the intrinsic value for you, and it calculates the time value. If you see over here, oops, I did it correctly. It calculated that 110. I had put in 111 and went on down through. Then the dark and green are the answers. So the spreadsheet. Now, if you try to put in anything except where it's yellow, a big old thing will come up and say you're not allowed to do that. It is if for some reason you want to override that, you just go to preview and take it off. There's no code word on this lock or anything else, so you're welcome to do as you like with it. So we look at this, and like we said on this chart here, it's better. Well, let's go on over and fill in over here then. So we have July. The option premium is $1.11. Okay, what does that tell us? It tells us that the intrinsic value is $1.10. It tells us that the time value is a penny. Okay. You still end up selling this for $14.09. The forward contract is still $13.90. Okay. You buy and sell options. I did that. I'll have to redo it. So we have $1.11. Minus 49 equals 62 cents. So 62 cents. Okay, how did I get that number? $1.11 minus 49 is our positive 62 cents. No storage cost, 20 cents. Brokerage. Brokerage. So this is a plus 61 cents. This is plus 41 cents. So 61 cents in our 1409 would be 1470. Okay, 61 cents, so 1 cent's 10, and 41 cents on top of that would be 1431. Okay, now these are better than these, as you would expect them to be, because we're working on this side of the graph. So if this was the situation today, on Fridays, these numbers wouldn't change any today. But if we had cash soybeans today and wanted to work on these, this would be the situation. So this is prices up. We're going to go to prices down, and a big bunch of this is filled in, other than the 1364, the 1385, the 12. Actually, that was 96. I had written 99 in it before, which was inaccurate. 1306, 1359, and 1320. So these are the same half, the same. What we're interested in now is prices going down. Okay, so in our example, let's say cash prices dropped off to from 1409 to 1190. July futures went to $12. Okay, that went to the same -10. So in this case, and it doesn't necessarily have to be the same if price went up or down. That's just the example. Okay. If I subtracted 20 cents from that, it'd be $11.70. This one here, I take $12. I add this 24 cents. And I'm at $12.24. Okay. So this is important here. Okay. When we look at the chart, we're on this side. Okay. Even when prices go down, you do better with a basis contract than you do with storing cash. Okay, so you say, well, if I sell cash and buy futures, futures could go down. The answer is yes. Of course, cash can go down too. So a basis contract or sell cash and buy futures was the correct decision, even if you made it because you thought the price was going to go up and they went down. Because by doing the basis contract, you lost less money than in the other direction. Here is the same example that I'm following. So again, we're going to July. Cash prices is $11.90. In this case, I sold futures for $13.85. I bought them back for $12. So I made $1.85 in the futures to help offset the loss in cash. I have my broker. I have my brokerage cost. Okay. So I made $1.85, but I had 21 cents in cost, and that gives me $1.64. That $1.64 I get to add to get my net price to $11.90, and we have $13.54. Again, 10 cents less because the basis was 10 cents worse than I expected. Okay, now, is the hedge better than 1170 or 1224? The answer is absolutely correct. But is the 1354 better than the 1370? No. Is it better than the 1409? No. The chart says don't hedge. If the price is going down, sell it today or forward contract it. The price went down, sell it today or forward contract. We're both better than the hedge, which we expected. And of course, when we compare just to sell it today or a forward contract, the 1370 or the 1409, it said sell it today. So let's go on over to options. Okay, we're still using July options. What's the intrinsic value? We have a right to sell for $13.60. We can buy it back today for $12. $13.60 in our pocket, $12 out. So the intrinsic value is $1.60. If we go that had to be, that's $13.80 obviously up there. That was typed in, not by the spreadsheet, so we're all right. It's $1.80. What if there was a time value of a penny still? What would we sell it for? Well, if you'd just gone right to the board to sell it, it would have been $1.61 and $1.81. Okay. This is money that you have to offset prices going down, just like you had the $1.85 in the hedge. This is the right to hedge. We still sell it for $11.90. Okay. We buy and sell options. We sold it for $1.61. We paid $1.43. So we made $1.18. We sold it for $1.81. We paid 53 cents. So we sold it for $1.28. Okay, again, it's more valuable insurance when the price goes down. So it's $13.80 versus $13.60. We still had our storage cost. We had our brokerage fee. So this was a net 97 cents we got to add on, and $1.07. So 97 cents and $11.90 is $12.87. Okay, and over here $12.97. Okay. Now, as you would expect, the hedge is better because we don't have to subtract off the premium. Are these better than if we just done nothing? With the cash, the answer is yes. They're even better if we did a basis contract. But if we used option, are they best alternative? So in order to calculate that out, we have to go over and calculate the calls. So the premium I went and saw as a penny. There is no intrinsic value because nobody wants the right to buy it $14 to turn around and sell it for $2 less than that. So if that was true, it must be that the time value was a penny. With this big a move and this late, the time value was probably going to be 1/8 of a cent or 1/4 of a cent, and something we couldn't really get anything out of. We did sell our beans for $14.09, or if this was a minimum price from the elevator, in essence, they locked that in. Or we forward contracted for $13.90. Obviously, this one's better. We paid 64 cents, only got a penny back, so we lost 63 cents. And again, these are the same two options here. We're just looking at one we're selling today and one with a forward contract. We have no storage cost. We have storage cost. And I did it wrong. This is minus 49 cents, so these are going to look better. So minus 49 plus 1 is minus 48. Everyone can read minus 48? Yeah, right. Minus 48. Brokerage cost of a penny. This would be minus 49. Brokerage cost of a penny, this would be 58.68 minus 69. Take 69 off of this, and you have 13.21. You take 49 cents off of this, and you have 13.60. The 9 cents, 14 and 40 more cents. Now you look at this 13.60 and even the 13.21, and we wouldn't have done the 13.21. And these will all come out tomorrow morning. These are significantly better than the puts, which you'd expect. The chart said we ought to be using sell cash or forward contract and buy a call. And anytime sell cash is higher than the net forward contract minus storage, we use the sell cash and buy a call. So to write this bigger, 1360, is that as good as 1409 today? No. But it's better than a hedge. And it protected you on the downside. Again, what are these here? This is the up and down. This gave you a downside, the worst you could do. We did a penny better than the worst you can do because we had time value, a penny worse than the less you could do because we had time value. So hopefully those couple examples, we would have found out if we'd done corn like we did last week, but put in 20 cents of storage cost, say at an elevator, we would have been on this side of the chart and we would have done it just like this. I didn't feel a need to put in another 6-7 cents a month storage if we had this at an elevator, because if the point is there with on-farm storage, it's just going to be magnified when we go to off-farm storage. The next example I want to look at is a change of pace now, what we'll call new information. We're going to be looking at that, and I'm going to be pointing it out on this one here. We want to look at new crop. Okay. Now there's two big differences looking at new crop. Okay. No storage cost. Okay. You might say, well, what if I forward contract to price it in January? Well, actually the decision to price it in January or February or March, different than fall, is an old crop decision. You first see, do I want to price it? And you look at new, and you use the December futures, or with soybeans, the December futures, and then you look, is the market paying storage after that? The other difference is, and you'll see later, is how we calculate the basis contract changes. Because remember, the basis contract in the old crop example is the difference between today's cash price and futures. When we calculate it with new crop, it's going to be the difference between the forward contract and futures. So when we go through this chart here, let's go over here, we can still do a basis contract. It's calculated different. Okay? We can't do a sell cash buy futures or sell cash. Yeah, we can know forward contract and buy futures. We can't sell cash and buy a call, but we can forward contract and buy a call, or we can do a minimum price contract. Over here, we can't store cash. What we do here is we wait to price. Okay. Delayed pricing we don't have to do because that would involve storing at an elevator. We don't store cash, but we can buy a put and wait to price. Okay. Or we could do this minimum price hedge to arrive, which is just an elevator saying, well, we'll set the cash price in the fall, but we'll buy a put for you now, which is like a right to hedge. You can't sell, back here you can't sell cash, but you can forward contract. Can't sell cash and buy a call, but you can forward contract and buy a call, and you can do a minimum contract. What they would do that is with a forward contract and a call. You can still hedge. Instead of store, you weight the price, but you still sell futures. Hedge to arrive is that exact same thing. Instead of store cash, we weight the price, and or minimum price hedge to arrive. But these, and the other concept is this basis here and what we expect. We don't have a today's cash contract. We have only a forward contract. So this cash equals forward contract. This cash equals forward contract. Forward contract and forward contract at this end, and then at this end it's cash. Because by harvest there'll be a cash price. Okay? So that's the key differences. We still keep an eye on the basis, because the elevators may be offering a very strong basis today. Just like here, they were offering a positive 5 cents. I haven't seen that too often at New Crop, but that doesn't mean it can't happen. So over here is they're offering a better basis on their forward contract than we expect later. Here they're offering a better basis on their forward contract than we expect at harvest time. Here they're offering a poorer basis on their forward contract than we expect at harvest time. And here they're offering a poorer basis than we expect at harvest time. So those are the key differences. We don't have storage cost. The basis contract is calculated a different way exactly because it's over here we're looking at the basis expected. The basis being offered today than expected. This isn't a whole lot different than the basis looking at the cash minus futures, because that forward contract they offer is as good as a cash price. Okay, it is the cash price you'll get when you deliver. This elevator isn't going to go broke on you, because yes, I know there is some slim risk, and some people got hurt in Michigan just a couple years ago. Okay, so when we look at that, if we looked at corn, we're looking at probably December futures. Remember, we have to use a futures contract that comes after the when we deliver. Okay, well, there's September futures and then December. So for new crop corn, we'd have to use December. If we were looking at new crop soybeans, we'd be probably looking at November, because the options will last October 20th and we'd be all right. Every once in a while we may look at January options on that. Again, I'm using Friday's close, so I could prepare over the weekend. I apologize again for preparing wrong on one option. So there's no cash price. So the forward contract being offered this particular elevator was $4.21. Or basically, basis offered was minus 50, right? The difference between 421 and 471. We have strike prices. This would be near the money. These would be out of the money and in the money. and out of the money, and these would be, out of the money and in the money, because this 420 is already worth at least 51 cents of intrinsic value. So we'll come back to these numbers here to get the prices. So we have this chart here that we'll be filling out. This is the one here. And then this one, hopefully I put in the right numbers here. 38. Yep. Okay, and we'll be showing that as we go through. Okay, so we're going to look at corn. Okay. I don't have this on the spreadsheet, but you have to keep it in mind. I don't have this loan rate on the spreadsheet. As we learn more about the government program, we'll figure more out about that. That's my job next week, to understand the government program. So it's 228.14, but we're talking about October, say 14, because that's when we'd be delivering the crop. I don't have production cost on the other one, because by now the market really doesn't care what your production cost is. And not that the market cares a whole lot about your production cost on new crop, but it does care to some degree. And why is that? The market knows, or people out there bidding the futures up and down, understand very well that you can grow corn, wheat, soybeans, and in places in this state, corn, wheat, soybeans, sugar beets, potatoes, dry beans, whatever the case might be. So in those terms, the production cost does mean something. Plus, this is when, as you're making a decision. So I just put a number in there for 50, and we'll talk about that a little bit more perhaps next time. That varies a lot for farmers because of their equipment cost. But some frame a restaurant. I've seen anywhere from the 4 1/4 to 5 1/4. Obviously I've seen higher, but that usually is the range. The forward contract is $4.21. If we look at December futures, they were $4.71. We're going to round down a half a cent. So what's a basis contract? It's the difference between December futures and the forward contract. So that'd be minus 50 cents relative to December futures. The elevator sometimes takes a little bit more risk in this one, because they give you that basis contract and they may or may not have the basis locked in real tight on this forward contract, but they know the basis pretty quick, and some of the smaller ones may even lock in that forward contract of a larger elevator. We'll talk about this one, the probability distribution of what the price may be next week. I'm going to put in an expected base of 45 because I tend to be more optimistic. Or to make a point, I have seen times where they offer, even right now, a better basis now than it be. The other thing I want to state about this expected basis on new crop. On old crop, I'm feeling pretty confident around that 5 cents one way or the other. And if it's further off than that, it's usually in your favor stronger. At harvest, the basis risk is more like plus or minus 15 cents. So we do have a lot more basis risk. So even though you're expecting a basis just barely tighter than stronger than the market, one, you still have a brokerage fee. So we're down here looking at 425 versus your 421. 4 cents, but this could be 15 cents higher than that. So that'd be a lot better, 14.40, but it could easily be 60 cents minus 60 cents. And then you'd be 15 cents. Then you're down at $4.10 and 11 cents worse than a forward contract. How do you take care of that if you don't have a real strong opinion which way the basis is going? Well, if you happen to think this is a good price and they're this close to offering you that basis, and you have a lot of basis risk, fall basis risk in your area, you can do some of both. Okay, these are usually in 5,000 bushels. This one here is. This one can be in any amount you want. But let's say I want to price 10,000 bushels at this price. I can always do some as a hedge to arrive, and another one as a forward contract. The more on-farm storage I have, I know we're not looking at storage here, then I might be a little bit here, because that way if the basis is like minus 60, I can roll that hedge later on, which we won't get to rolling hedges in this introductory class. But oftentimes there's a way of, if the basis is wider at harvest than you think and you have on-farm storage, you can roll it to a later time and get that basis, weak basis back often, or at least a bunch of it. So we're still going to, if we look at options here then, so neither one of these is full cost of production. On the other hand, when we look at the odds next week, there's some chance that, prices could be 3 1/4, probably a 10% chance. Our strike prices, I'm going to look at two of them. I'm going to look at 14.60, and then I'm going to look at the money of 4.70. I got to get from soybeans back to corn. We look at the option premiums there. The option premium on this one is, remember, this is 7/8. So I'm going to call this 32 cents. This is 7/8, so I'm going to call this 38 cents. Those are a cost. So I will look through it this way. The expected basis is still 45 cents. The brokerage fee, I'm still using a penny. So we have 382 and we have 386. This is 4 cents better. Why? We're getting 10 cents extra protection for 6 more cents. So we'd expect we'd be 4 cents higher. We'll send this out, those numbers over just above the arrow over there. So we look at the last one, and we put 2 of them over there. We're only going to put 1 here. We're still looking at December. We're looking at a strike price of 4.70. I put a 4.80 in there. We don't have a cash price. We only have forward contract. Don't have to worry about storage. We have a premium of 39 cents. On this 4.70, I'm using this 38 5/8 and rounding it up to 39 cents. We have our brokerage cost. So down here we have 3.81. Now what does this tell us with respect to where we are on this sheet here? Oops. Well, we'll just stick with this one right now. Where are we? We're just barely on this side of the chart versus this side of the chart. So if I might do a 1/3, 2/3. Okay. I'm expecting a little bit better basis. Let's say I'm in a financial position where I can take a little more basis risk. So we're on the right side of the chart just barely, and you can see that when we come down here as well. But this time it's really close. Okay, what that means is I'm going to worry more about prices going up or down than maybe whether I pick up the storage tool or not. Now remember, I can always, I haven't really told you, you can always change these, a lot of these decisions you can change at harvest time. If things change by harvest time and we've, say, weighted the price, we have another choice at that time whether we're going to store cash or do a basis contract if we think prices are going up. So let's use a prices down example. Okay, so prices down. Harvest price drops to $3.25, and there's probably about a 20% chance of that happening. We look at December. Futures are went to $13.80. They're not now. They're $4.71. They actually were up a few pennies, I think, today. The actual basis turns out to be minus 55 cents. Okay. Worse than the 50.45 I thought, and the 50 cents that would be an offering. You take 50 cents off of that, and you have 3.30. So it turned out the basis contract was a little bit better. Not a lot better, but a little bit better for a pretty much, 10 cents wider basis than you were expecting. This isn't a perfect science, and at harvest time, predicting this basis is even harder than other times of the year. So we take the cash price on the hedge, $3.25. We had the right to sell at $4.71, buy it back at $3.80. That's a positive 91 cents. Had to pay our broker. So we ended up with 90 cents better from the futures after we were done doing that exercise, and we came in at $4.15. Is $4.15 as good as $4.25? No, but it's still a lot better than $3.80. This is where that basis risk. If this had turned out to be 35 cents, this number here would have been $4.35. So this basis can go in either direction. So we go over to options, and we look at the here. All of a sudden I say, 81 cents I can sell it for. That's a positive. I can sell it for 91 cents. What is that? Well, if you come over here to the other chart, and I'm going to put the arrow right, if I can get to it, in the middle of the thing. Okay. 80 intrinsic value is 80 cents. I said a penny time value. Intrinsic value was 90 cents. I said a penny time value. We still sell it when we do the put for the $3.25. Remember, this is weight to price by a put. So what did we make buying or selling options? Well, we bought the option for 45 cents. We sold it for 81 cents. So we made 49. Over here we made 53. It cost us a penny. So we were at plus 48. Cost us a penny. So we're at plus 52. And our net value, we take the 48 and add it to 425, and we're at 373, and we're at 377. Now you say, oh my gosh, I'm worse. I'm 9 cents worse. What happened? The basis was 10 cents wider than I expected. I picked up a penny of that back on this time value. If I'd harvested in September, with the same prices, I may have picked up, I've more likely picked up that time value. So did it do the job? Yes, it gave me downside protection. 373 and 377 is certainly better than 325 and 330. But not as good as 415 or 421. Over here we sold it for a penny. It was all time value because I don't want the right to buy at 470 to sell at 380. So we still have a forward contract at 421. We sell and we paid 39 cents. We got a penny back. So it cost us 38 cents minus a penny, and we're minus our 39 cents. 39 cents from 421, and we're at 382. Okay. 382, even though it seemed like it was a little worse up here, I have no basis risk over here. When I forward contracted, I took away my futures risk, I took away my basis risk. By buying a call, I gave myself back to have the futures upside if I wanted it. Over here, by waiting for cash, I left my futures open, I left my basis open, but I gave myself the right to lock in futures at 460 if I wanted to. So it turned out what we expected. We decided it was pretty close. It turned out to be a little more on this side of the chart than that side of the chart. But that's not the kind of error we worry about in marketing. We got to worry about bigger ones. We could go in the other direction. Okay. We could fill out another chart. Okay. The top part of that chart would be the same. The bottom part is what would change. So what you do here, it's kind of convenient. I'm going to take this page right here. I'm going to go like this. Okay, and then I'm going to go prices up as I go through another and last example. And when we get through this, we'll be all set up for next week. So we did prices down. We're going to look at prices up. Somewhere in the world, the crop's not as good. And prices go up to $6. And December futures go up to $6.40. What would that make the basis? Remember, the basis is cash minus futures, so it's minus 40 cents. Okay. What does that tell us? Immediately, we're 5 cents stronger than we thought. So down here, I'm going to add a nickel to this 425, and we'll see if that's right. Basis contract is still 50 cents off of that, so that's 590. Okay, in this case, unlike the other one, we ended up a little bit more towards the right-hand side. Again, it was hard to predict when the basis that we expected was so close to the basis being offered at the marketplace. Cash price at harvest was $6. This time we sold cash at $4.71. We had to buy it back at $6.40. That's $1.69 loss. We also had to pay the broker, so we're down $1.70. And you know, those numbers are right over here. Again, yellow being input, this green being the output. So you take $1.70 off $6, and lo and behold, you're at $4.30. Why are we 5 cents better? Because the basis strengthened 5 cents more than we expected. We go over December, the premium, and I tell you the premium is a penny. So what is that? Is it intrinsic value? Do you want the right to sell for $4.60 when you have to buy it back for $6.40? The answer is no. So no intrinsic value. Intrinsic value equals 0. So we have $6 we still sell it for. At that point, we're locking in futures and cash. We paid 32 cents for it, got a penny back. So that's our 31 plus brokerage, so 32 cents. 32 cents under $6 is $5.68. Okay. Is $5.68 as good as $6 or even $5.90? The answer is no. But it's a lot better than the hedge. And it ended up being better than our cost of production. Although we could have had as low as 380, 382 or so. Or with the basis risk, we saw a little bit more. This would be minus 37, the 38 cents plus a penny gain. The brokerage, minus 38 cents for a net of 562. Okay. Well, that's different. The more expensive insurance paid us more when the market went down. But remember, the more expensive insurance cost us 6 cents more. So we got 6 cents less on the net return. We go over to the last one. I tell you, we sell it for $1.71. The forward contract was for $4.21. $4.21. Yeah, that number's right on the other sheet. $1.71. We paid 39 cents for it. So we made $1.32. $1.71 minus 39. Had to pay the broker. So we made $1.31 from the options market. We added to the 421, and we're at 450. 452. So is the 452 as good as these? No. Why? Because we locked the basis in here, whereas over here on the downside it was a tiny bit better when the basis went against us. But these are higher because, one, we were expecting a little higher basis, and then the basis turned out to even be better than we expected. So our 10 cents here pretty much explains most of this, and then the little bit higher cost explains the rest of it. So we have these different tools for new crop and old crop. We have these spreadsheets, and those work as long as you put in the right numbers. So we'll come back to this to end this session up of where we're trying to go. I'll have these calculated and I'll send them out the night before, and then we'll go over them. And the idea is we want to quickly look at some, where's the corn market fundamentally and technically, the old crop? Where's the corn market fundamentally and technically, new crop? Which side of given the numbers here, which side of this sheet are we on the left or right hand side? Thinking a little bit about your cost of production. We won't be able to get in a lot of times because we don't know whether price is going up. I always think of two parts to my pricing goals. And be thinking about these things. One of them is, if I get such and such a price, I might price so many bushels, and that would be based on what I think the market's going to do, my cost, how big a hit to my financial situation will be if prices go down, how big a, if I lock them in, can I lock in my net worth today from not getting any worse, those type of things. So we can't cover it all, but we'll start talking about some of those ideas. So a mini marketing plan. Put in perspective of where I think the market is today, where the market is telling you is today, both on old and new crop soybeans and old and new crop corn. Dennis has a comment here. It reminded that I resent the commodity outlook presentation from last week. What I tell you next week doesn't change hardly at all from the outlook presentation which I sent you a link to last week. If you can't find that link, you can go to my webpage. It is also up on my webpage, the link to last week's, so you'll get a pretty good feel. As we know, unfortunate situation in Ukraine does add more risk to the market. Much more risk than I thought was going to be in that presentation last week when I was specifically asked that question. So that's, the market kind of builds in some of those risks. So we'll also look at what's the market saying our risk is for our old crop corn and soybeans, say, going into June. What does the market think the risk is of old and new crop corn and of new crop corn and soybeans as we go into this fall? The other thing you have to think about real hard and really yourself, because each person's different, is what's the probability distribution on your yield and how closely are you correlated to the national market. Michigan's not super correlated, especially once we get up one tier of counties to the national yield. That we found out that last year over much of the state. If you have irrigation, you're not, the yield risk may not be, well, the yield risk certainly wouldn't be as big. It doesn't mean you wouldn't have yield risk. So again, I'm going to send out these notes even with the errors in them tonight. Those will be all fixed up when I send it out tomorrow. I'll send out the link, and on the third page of the notes, you'll see the Dennis Stein's email if you're interested. And I do see that 3 people here from Gratiot County are interested, and we're taking notes on that. It looks like somebody's trying to get one more question in here, down here, typing. Are there any more questions?
And Wednesday's the last class?
And Wednesday is not the cost of production a key factor when trying to figure out new crop prices? I think cost of production is very important, but remember, there's not one number. You do cost of production, and you do your cost of production saying, I think I'm going to have 150 bushels an acre. So if that's true, my cost of production is 450. If I have 75 bushels an acre, my cost of production is pushing $9. And if I have 200 bushels, my cost of production is down around $3.90 or to $3.70. So yes, it's very important. I'm a big believer in knowing your cost of production very strongly. But maybe it's that cost of production per acre, and what portion of that are we likely to be able to lock in. So it's important, but the last thing I'd ever advise is, as soon as the price of your cost of production, lock it in, because you might not have yield. The market could go up. There's a lot of other things. So yes, it's very important. It's a key factor, but it's only one of a number of key factors when we make our pricing decisions. Thank you. Good question. Well, not seeing any more questions, and it being basically 8:30, we're going to see you on Wednesday. Remember, Wednesday is the last session. These sessions will all be up on my webpage, along with all the notes and background reading for the